Good morning, everybody. My name is Jeff Hearn. I'm the COO of Zishi, a learning partner of the Financial Academy, and it's my great pleasure to welcome you to this webinar today. We'll get started shortly, but just a couple of housekeeping things to make you aware of. At the end of the session, there'll be a QR code where you can register to get your certificate of attendance. So please follow the session, get to the end, and then you can get your certification. We'll also have a Q&A, so we're streaming across multiple platforms today, so you can engage, put comments in the different platforms. We'll pick them up and we'll aim to answer those at the end of the session. The session is going to be run by my colleague, one of the leading options experts in the field, Mr. Mark Taylor, and I know Mark's going to share some amazing content with you today. So anyone with an interest in options, this is going to be a fantastic session for you. So without further ado, and in the interest of time, I'll hand over to my colleague Mark Taylor, and we will begin the webinar on single stock options.
Good morning, everyone. Thank you, Jeff. My name is Mark Taylor. Welcome to this 2-hour webinar on single stock options. We're going to be going through the basics of how we trade options, how the mechanics of the product work, and talking you through how you might use these products as an investor, as a trader, or even use these products to hedge the risk that you might have. The course will run 10 till 12 Riyadh time, and then we've allocated about 30 minutes at the end for questions. So as Jeff said, however you're watching this today, please feel free to drop questions onto whatever platform you're on. The team at the Financial Academy are going to pick up those questions. They're going to relay them through to me, and then we'll use that last 30 minutes to answer anything on that. Anything to do with registration, you should find some details on the platform that you're watching this stream on. There will be a QR code displayed at the end and in the breaks that you can use to register. Okay, let's get stuck into the content then. Firstly, just a little bit about me. I've been a trainer, as in a teacher in finance, for the last 15 years. So sitting in front of audiences like this, everything from complete beginners all the way up to chief executive levels at some of the major investment banks. I teach courses primarily about derivatives. That's my background and that's my speciality. And I myself was an options trader before I became a teacher of derivatives. So I was an options trader for 10 years. I traded both foreign exchange and interest rate options in my professional life. In my life as a private investor, I've traded equity options that we will be talking about today, single stock options and index options for the last 25 years. So hopefully that gives me a reasonable background to explain the subjects and also to be able to competently answer any questions that you might have today. As well as being a trainer, I also work as a consultant. So when I'm not teaching courses like this, I work on consulting projects. Often those are risk management projects for banks. Sometimes it's regulatory projects, the way banks use products and how it interacts with regulators. And a lot of those consulting products are based around the equity markets, and many of them involve the trading of single stock equity options. So again, that's another thing that I've got to draw on to give me experience and to give me the ability to explain these things to you. Right. Let me just tell you how the schedule is going to look. So between now and around about 10:40, we will be talking about just a basic introduction to options, the mechanics of the product, how does the payoff work. We'll then take a 5-minute break, and then we'll talk about how you use these to trade. If you have a certain trading view, how would you use an option to express that view? We'll take another break at the end of that session. That will be around about 20 past 11. And then the last session will run from 11:25 through till midday. And that will be on pricing, the importance of volatility, and then how we understand the risk measures that we will get from options. If you're trading single stock options on the Saudi Stock Exchange, you will see that not only will you get prices to trade on, but you'll also get risk figures and volatility figures. So that third session is to explain what those numbers mean, how you would use them, and how you would understand your position and the generation of a profit and loss based on the trades that you do. Okay, so 3 parts, that's the summary. 3 things we're going to try and take out of this. We're going to try and walk away at the end of 2 hours knowing what options are, how they work, why we might want to trade them. Many of you who are following along may be experienced traders in the equity markets or experienced investors. Maybe you've invested your own money or you work for an institution that trades in these markets. Maybe you're at the moment trading cash stocks. Maybe you're trading futures. We're going to try to enlighten you as to why options might make a difference to the way that you invest or the way that you trade. What does the product add that makes them different from trading cash equities or single stock futures? And so we will see as we go through the slides that there are trades that you can do with options that you simply cannot do with a futures contract or a position in a cash stock. And so that's what makes options interesting. That's what makes people attracted to this product. And then, as I say, we've got a bit about pricing and risk at the end. Option pricing can get complex. If we wanted to derive the maths from scratch, we generally need a maths degree in order to be able to do the maths, but we're going to do none of that today. We're going to talk intuitively about the different price drivers, why movements in certain variables should have an effect on the option price. And yeah, we'll try and keep that section as light as possible. Okay, so the first part, introduction to the option product. So the first thing to explain is the terminology. For those of you who aren't familiar with options in finance, option in the English language means a choice. If I give you the option to do something, you have the choice to do it or not. And in finance, it means the same thing. So an option in finance is the choice to either buy or not some stock in the future, or sell or not some stock in the future. And so we have 2 different types of options. We have a call option, which is the right to buy, and we have a put option, which is the right to sell. Note that there isn't an option that gives us the right to either buy or sell in the future. Call gives us the right to buy or not, and the put gives us the right to sell or not. But as we'll see later on, we can combine calls and puts together to create different payoffs. So this is what a hypothetical option contract might look like. Physical certificates, or certainly back in the days gone by, they would have been physical certificates. And right up there at the top, we have the option type. So we can see here that we're talking about a call option. So this is going to give us the right to buy the underlying stock if we choose to do so. You can see that the holder has the right to buy this hypothetical stock called ABC. They have the right to buy it at 100 rial. So the stock that you have the right to buy from this call option, we call that the underlying, or the underlying stock in this case. And the price at which you can buy it, in this case 100 rial, we call the strike. Now sometimes you might see this called the exercise price, or maybe the strike price. Strike will be how I talk about it. If you were to look in a textbook on options or any kind of academic paper, you might see the letter K being used for strike. So again, we might use K throughout this webinar, and if we do that, it just means strike. So strike is the price at which I can buy this stock in the future. When in the future is the next question. So the 21st of March this year, let's pretend we were a year ago now. This is going to be some date in the future when I have the right to exercise my option. So I buy the call option, I wait until expiry, and then I make my decision to buy or not. And the final piece on this slide is the premium. So the premium in this case is a cost that I pay today in order to give me this valuable right to be able to buy the stock at 100 rial in the future. And so here I'm paying 5 rial per share in order to buy the stock. Okay, so the way that we would understand how this works is our decision is going to be based around where this strike is and where the stock finishes at the end of its life. So let's just for a minute imagine that this was 2005. And so there would be, I don't know, something like 8 months left to expiring. Well, in 8 months' time, I need to make a decision. Do I exercise my option and buy the underlying stock, or do I walk away? My exercise decision is going to be based upon where the stock is trading at expiry. And let's say the stock at expiry was trading at 110 Rial. Now I can look at my call option and I can say, yes, I will buy at 100. I will exercise my right to buy at 100 because it's lower than the current market. And if I want to, I can buy the stock at 100 and I can instantly sell it at 110 in the prevailing market, locking myself in a gain of 10 Rial per share. If the stock at expiry was trading at 85, or indeed anywhere below 100, then it would not be optimal for me to buy the stock at 100 through my option, because I can turn around and buy it in the market at 85 instead. So I would simply walk away from my call option. In the terminology, we say I would let it expire worthless. I'd walk away, and if I still wanted to buy the stock, then I'll buy it at 85 in the market. So you can see that this call option gives me a valuable choice. Either I will do something in the future which is good for me, as in buy the stock below the market price, or my future will be flat, in that I will just walk away. There is no situation where I'm forced to buy and take a loss because the market is lower. And really that is the beauty of trading options, this positive only payoff in the future. That is why we pay the premium. Remember, if I buy this option, somebody has to sell it to me. Now, if my future can only be positive or flat, then the seller's future can only be negative or flat. And so it makes sense that they charge me a compensation payment up front, and that's essentially what the premium is representing. Okay, so if we have a look at a graph, then this dashed red line is what we call the option payoff. And so this would be the payoff of our 100 call. Now down here on the x-axis, there's 100. And so you can see when the stock finishes above 100, we exercise our call option. And when the stock finishes below 100, we walk away. However, we need to account for the fact that we've paid this premium. So if the stock finishes below 100 to the left-hand side of 100 on the x-axis, then we'll walk away from our option and we'll have lost the premium that we paid. So we'll just be down 5 Rial. So our P&L will be -5 from a finish at 99.99 all the way down to 0. So it doesn't matter where the stock finishes below 100, our P&L is going to read -5. If we start to move up, and so the stock starts to finish above 100, then for every 1 Rial that it finishes above 100, our payoff goes up by 1 Rial. So the payoff moves 1 for 1 with the underlying stock. But of course, I've still paid that 5 units of premium. And there will be a point, and you might not be surprised to hear that we call it the break even, where my option payoff is exactly equal and opposite to the premium that I paid. And if we ignore the time value of money for just a second, so we can say that 1 Rial today is worth the same as 1 Rial in a year, essentially we're assuming interest rates are 0 in order to do this, then that break even is going to be when the stock is trading at 105. Because when the stock is trading at 105, I buy at 100 through my option, I can sell at 105, so I make a payoff of +5. I paid 5 Rial of premium for the option, and therefore my net P&L is 0. So anything above 105, I make a clear profit, as in my payoff is greater than the premium that I paid, and anything below 105, I make a loss, in that the payoff is either less than the premium I paid or the payoff is zero and I've just lost the premium. It's important to recognize, let's say the stock finishes at 102. If the stock finishes at 102, I should still exercise my option, even though I'm going to finish in this segment where I make a loss. I should still exercise my option because it will produce a payoff of +2, and I can then offset against that against the 5 units of premium that I paid, and my overall loss will be 3. But that's better than taking a loss of 5. So my exercise decision is based solely on where the stock finishes relative to the strike. It's not a function of the premium that I paid on day one. Okay, so we've got 2 different types of options. We've got a call option and a put option, and there's 2 different things we can do with them. We can either buy them or sell them. And therefore, there's actually four different trades we can put on with basic options. So here's the long call in the top left. Pay the premium. I make money if we finish above the break even of this option, as we've just seen from the previous slide. And if I'm an investor or if I'm a trader, we might say that my view on the stock is that it goes up. So the stock goes up, particularly if I have the view that the stock goes up significantly, as in we get a major move to the upside, then being long a call option should pay off. I think we're going to finish above the break even. Long a put is the mirror image of the long call, because the put gives me the right to sell instead of the right to buy. So I'll exercise a put option when the stock goes down, and I'll walk away from it when the stock goes up. And if the long call is a view that the stock goes up, then the long put must be a view that the stock goes down. Again, a significant move down would be beneficial for the owner of a put option. Okay, for every buyer, there's a seller. So the short call position down in the bottom left, that's the mirror image of the long call position, of course. There's only 2 counterparties in this trade. They should have opposite results from each other. And we might say, if I sold a call as a trade, we might say that my view is just that the stock does not go up. Because if the stock stays the same or goes down, I make money in that I keep the premium that I've charged. And only in the situation where the stock goes up above the break even do I outright lose money. And then the final quadrant here is the short put. Of course, that's the mirror image of the long put. It's also the mirror image of the short call. And that could be used as a view that the stock does not go down. So one thing of interest here is it's quite common for people to use options to take directional views on the stock. And so one of the views I might have is that the stock goes up. Now, if I've got the view that the stock goes up, there are 2 strategies on this page that I might choose between. The one obvious strategy is that I buy a call. The second one is I could sell a put, because both of those strategies make money if the stock goes up. They make money in different ways, but they both make money if the stock goes up. So sometimes you'll see people trading options and they'll only ever buy options. So they'll only take a long position, either long a call or long a put. But it's worth considering that you can take short option positions as well, and you can tailor your P&L profile to what you actually think will occur in the underlying stock. Okay, so we've got a few recap questions just embedded within all of these slides. This is just an opportunity for you to just take a moment to have a think. And I'm not expecting you to pepper X or YouTube or whatever with your answers to these. You can answer this in your head. I'll give you 30 seconds to have a think, and then we'll come back and you can see if you're right. So the question here is, you think that a stock goes up significantly. Which of these trades do you think makes the most sense? So I'm just going to give you 20 seconds or so to have a think about this, and then I'll circle my answer. And then we can talk about maybe if there's more than one right answer on this page. Okay. classic answer here would be A. You think a stock goes up significantly, you should buy a call. You think you've got that payoff profile here with some break even. Presumably, if you think the stock goes up significantly, you're thinking it finishes in this profitable area to the right-hand side of the break even. And I would say that's the undisputed correct answer to this question. You could argue that selling a put might also make you money, but it won't make you as much money on a significant move higher in the stock because you're talking about just collecting premium. You're collecting premium for having sold an option which has proved to be worth zero, but that premium just stays constant regardless of where the stock finishes. So a significant move up is really going to benefit that call option where the payoff moves 1-for-1 with the stock. Okay, slightly different question here now. You think a stock goes down, but not by much. Which of the following trades makes sense? So again, I'm going to give you 20 seconds or so to have a think about this, and then I'll tell you what my answer is to this question. Okay, so firstly, let's rule out the impossible answers. So if I think a stock goes down, I'm not buying a call. If I buy a call, I pay premium and I only make money if the stock goes up. So if my view is the stock goes down, buying a call is the last thing I do. I'm probably not going to sell a put. A put option is something that somebody would buy if they think the stock goes down. So selling one when I think the stock goes down, it doesn't seem like a sensible choice either. So I'm left with the remaining two options. And my choice out of these two, given the circumstances of the question, would be to sell a call. If you sell a call, you collect the premium. And if the stock goes down, even if it goes down by only a tiny amount, you still collect that full premium and your option will finish worthless. If the stock actually just stays exactly the same, it just trades sideways at a constant number, then selling a call will make you money because you'll just collect the premium. Buying a put, you really need a significant move down because you have to get down below that break even where the option payoff pays for the premium. And so the risk here is you buy a put, you spend 5 Rial of premium per share, you do get a move down in the stock, but only by 4 Rial. And so your directional call on the market was correct, but you've lost money on your trade because you didn't get down through the break even of your put option. And you see that many times in markets where people have called the direction of a trade correctly, but they've used the wrong option strategy to express that view and they've ended up losing money. Okay, so that's the basics, that's the mechanics of option. Let's deal with some of the terminology. There's a word called moneyness. It's a slightly strange word in finance. I don't really know where moneyness came from. I don't think there's a better alternative though, unfortunately. Moneyness describes where we are in the payoff spectrum of an option. Are we in the money? If we're in the money, then what that means is the option is looking like it will produce a positive payoff. So for a call option, that means that the market is above the strike, and for a put option, the market is below the strike. The opposite of being in the money, as you might imagine, is out of the money. Out of the money is saying to you, if the market finishes where we are now, this option will be worthless. So we're talking about a call option where the market is lower than the strike, or a put option where the market is higher than the strike. So if you have an out of the money option, you need a directional movement one way or the other to make it in the money. So what we're hoping when we're trading options, if we're trading them for a directional view and we're buying them, we're hoping they finish in the money by expiry. If you had an option where the strike is exactly equal to the market, we would say that is at the money. So if you hear about at the money strikes, they're the ones that are at or certainly very closest to the current underlying market. Now, it's quite rare to get an option which becomes at the money during its life, because you've got to get the market and the strike perfectly aligned. But at the money options are some of the most popular to trade, because if I've got a stock trading at a price of 100 real, the obvious strike to choose to express a directional view is 100 real, is the current market level. I could choose to trade an out of the money option. I could choose to trade an in the money option if I wanted to, but most people will be trading at the money options or options which are not too far away from the underlying market. So often you have a lot of trading in the at the money options, and then of course the stock moves and those options become either in the money or out of the money. Okay, so let's have a look at some of the single stock option contract specifications. And I'm going to deal with the ones that are listed currently on the Saudi Stock Exchange. So currently you can trade options on 4 underlying shares, and you can see those in the top right there, including Saudi Aramco, of course. Each option contract gives you the right to buy or sell 100 shares. So if I buy one call on, let's say, STC, then that is the equivalent size is 100 shares of STC. So if I then choose to exercise my call option, 100 shares is going to be the size of the underlying trade. Just like with futures contracts, you have tick sizes. Tick size is the minimum price move that the exchange will allow. And you can see that's 1/100th of 1 real. That's not far off the usual tick size, that 100th of the currency unit. And the tick value is that each tick will make or lose you 1 real. So if I buy one call option and the market price for that call option moves up by 0.01 real, I'll make 1 real of profit. So the value for a full real move, for a full 1 real move, what we call the value per point, is 100 real. And of course that makes sense because it's referencing 100 shares. If I bought 100 shares and the price went up by 1 real, I'd make 100 real in profit. Contract expiries, because they're exchange traded, we have certain standardized expiry dates. This is true of futures. It's also true of options. And so what the exchange gives you, it gives you a current month. So there'll be a date within August, which will be currently trading. There'll be the next month, so there'll be a September date, and then you'll get quarterly dates thereafter. And you can see that the expiry is going to be the 3rd Thursday in each of these months. So if you want to, you can go through whatever system that you use to access the Saudi stock market, broker, electronic trading, something like that, and you'll be able to see all of the expiry dates for these 4 companies and choose which option you want to trade. Now, this is quite an interesting piece of information. The exercise style here is American style. And what American style options are is American style options give us the right to exercise on any date. So earlier on, when I was describing the basics of how options work, I said that we would buy an option, we would wait, and on expiry, we would make our exercise decision. Well, that's actually not quite true of exchange traded options. What I described earlier on was what we call European style. And European style options, you can just exercise them at one point in time on the expiry date. But for American style options, you can exercise continuously between now and the expiry date. Now that's in theory. In practice, you have to inform the exchange if you're going to exercise. And so there are windows during the day when exercise intentions can be communicated to the exchange. And again, if you want more information on that, then the Saudi Stock Exchange is the place to go. But generally speaking, I would imagine it's between regular trading hours during the day. You can inform the exchange, I want to exercise my option, and then your option will be exercised. One thing you'll notice is if your option is in the money at expiry, it will be automatically exercised. You don't need to do anything manual in order to exercise an option, which is obviously going to produce a positive payoff. When you exercise, you end up with a physical position. So what that means is if I've got one call option contract and I choose to exercise it, I am buying 100 shares. And I get those 100 shares when I exercise. So if I wait until the final expiry date, then I get 100 shares on the expiry date. If I exercise early, taking up my right as the American style exercise holder, if I exercise early, then I get those 100 shares at the point of exercise. When I say at the point, there is a 3-day settlement delay, but that's the standard settlement delay for trading shares. Okay, so we're just coming towards the end of this first section before we take our first 5-minute break. And so it's worth just taking a moment just to compare options with stocks. How does trading one or the other give us different opportunities? And so here, if we just compare options with trading cash stocks, if I want to buy a stock, obviously I need to pay the full price of the share up front. If I really do have a share trading at 100 Rial, if I want to buy one share, I need 100 Rial today. With an option, there's only a small upfront payment if you're a buyer. You're paying the premium only, and often the premium can be a small fraction, in fact many times somewhere 2 to 5% of the price of the share itself. So we saw that option example earlier on where the stock was trading at 100, but the premium was only 5. So I'm only putting 5% down today. What that gives me is leverage. It means that I don't need a lot of cash today in order to take a reasonably large position size. And leverage is useful if I want to amplify my gains, if I think I have a strong trading view and I want to maximize my return on investment, then leverage helps me because I put a small amount of cash down today and I might generate an outsized payoff, a big payoff as a proportion of that cash payment today. Just bear in mind, though, that leverage cuts both ways. It amplifies losses just as well as it amplifies gains. So you need to use this with care. If I trade options, it's actually easy for me to take a short position in a stock. A short position is when I bet that a price goes down. Now, with regular cash stocks, sometimes that can be a bit difficult. If I want to short sell a regular share, I need to be able to borrow it from somebody else. And often, major institutions have the ability to borrow shares from each other. So you might have got pension firms or insurance companies which are long-term holders of shares, and they will lend those shares out to people who are looking to short sell. But if you're a retail investor, if you're a regular person in the street, you've got a trading account or an investment account, sometimes your access to short sell shares is limited, or maybe it's impossible. Well, with options, it's not. Because if I want to express the view that a share price goes down, I can buy a put. And buying a put gives me an effective short position in that stock, because if the stock price goes down, I will make money. Asymmetric P&L. This is the beauty of options. We have this kinked payoff diagram where I make money in one direction and I don't lose money in another direction. That's a trade-off that you can only get with options. If I buy regular cash stocks, my payoff is linear. I make money when the stock goes up and I lose money when the stock goes down. So as we'll see in section 2, this allows us with options to create much more interesting payoff profiles, much more interesting terminal outcomes to our trading view than we could ever do if we trade just cash stocks or indeed futures contracts. And the leverage point we've mentioned before, but high leverage in options, low leverage in cash stocks. So if leverage is your thing, if you're wanting to generate amplification of returns, then options give you the chance to do that. And here's an example of that leverage at work. Now, we're not going to go through all of the numerical details on this slide, but just suffice it to say that both the left-hand side and the right-hand side are representing the same effective position. So what we've got here is we've got an effective position of 1,000 shares. On the left-hand side, we're using the cash stock market to buy 1,000 shares. And on the right-hand side, we're using call options to give us an effective position in 1,000 shares. So you can see that I've bought 10 contracts of a call option. Each contract is on 100 shares. So that's an effective position of 1,000 shares. Firstly, you can see this leverage. To trade the cash stocks, I need to put 100,000 real down today. To trade the options, I only need 5% of that. So I'd need just 5,000 real. And you can go through the numbers yourself, but you can see here in the percentage returns the effect of that leverage. Gearing is another word for this, the effect of that small down payment compared to the large effective position size. So you can see as the stock price goes up, I generate some really quite high returns on investment using my call option, but equally when the stock goes down, I lose all of my premium. And so you can see minus 100%. Compare that on the left-hand side with the return on investment for the regular stock, and you can see you can get much more extreme returns if you use options. One more slide before our short break. These are some more advantages to trading options. You can trade a particular time period. If I think a stock's going to move in the next 6 months, I just don't know when, then it would be difficult for me to time that trade well using the underlying cash market. Possibly I think a stock goes up over the next 6 months. If I do, I can buy a call option and I can just sit and wait. If the stock goes down first, it doesn't matter. It's still got time to come back up again. If I was just to buy the stock in the cash market and the stock went down, I might start to think, maybe I should cut my loss. Maybe I should trade out of this position. I might cut my loss and then be annoyed when I see the stock go back up again. So it allows you to trade a time period. It allows you to have an income receiving strategy. So if you sell options, that is a way of receiving income. You are exposing yourself to potential downside in the future, but you receive income today to compensate you for that. So there are many investors who like trading options because they like to sell them, receive income today, and then essentially their view is that the payoff in the future will be less than the premium that they've received today. And as we'll see after the break, we can create quite pretty pictures. We can create these tailored, bespoke payoffs by combining different options together. So once we've had a break, we'll come back and we'll talk about trading with options, and we'll move on to option combinations where I trade more than one option as a package. So that's part 2. We'll take a 5-minute break now just for you to grab a coffee, turn away from your screen, take a breather. We'll restart in 5 minutes time, and we're going to talk about part 2, which is trading with single stock options. So I will see you in 5 minutes. Welcome back, everyone. Okay, we're going to proceed now into part 2 of this webinar, trading with single stock options. Just before we do that, just to encourage you that you can ask questions as you're following this live stream. The best way of doing that is if you're following it on X, formerly Twitter, if you reply to the post, then the Financial Academy team will pick all of those questions up and they'll put them in front of me, and then in that last 30-minute section, we can see if we can answer those questions. So any questions you've got, just reply to the post on X, and the Financial Academy team will pick those up. Great, good. Right, let's make some progress. So we've deduced what options are, how the mechanics of the product work. We're now going to talk about how we might use them to express a trading view or an investment view. Okay, so if you were to see an option price on an exchange screen or on any kind of trading screen, at first they can look a little bit daunting because what you'll see is numbers everywhere. What we call is we call this an option price chain. So there's a link of a variety of different prices on this screen, and the first thing to show you is that the strike down the middle is showing you the strike of each individual contract that you can trade. Now, bear in mind that this will be just for one expiry date, so there'll be several price chains that you can trade on. So down the middle, we've got the strikes, and let's say this is on a stock which is trading at 100, then the at the money strike is going to be that 100 strike right in the middle. Okay, so if I just highlight those, you can see this is our at the money strike in the middle. And if we look across to the left, we can see the price of the at the money call. So those two numbers there, this is the price we can trade at for a 100 strike call. Now, many of you will be familiar with bid and ask prices. The bid price is the price as a user of this exchange, is the price at which I can sell, and the ask price is the price at which I can buy. So many people are putting bids and asks into an exchange at any point in time. You'll also have market makers on the exchange who are quoting bids where they're willing to buy, asks where they're willing to sell. So as a market taker, as a user, as a client of this system, I'm going to sell at the bid price and I'm going to buy at the ask price. So if I want to buy this 100 call option, then 5.778 real is the price that I would pay. Now, if we go down in strike for the put options, or if we go up in strike for the call options, these options become out of the money. So you can see if I wanted to trade the 110 call, I could buy it with a lower price of 2.63. Now, we're going to talk about pricing in the last section, but let's just preemptively have a little think about pricing now. Does it make sense that the 110 call has a lower price than the 100 call? Well, yes, it does, because I need a bigger move up in the stock to get above 110 than I do to simply get above 100 where we're trading at right now. So if I bought a 100 call, it would have a higher probability of finishing in the money and paying off than a 110 call would. And if I bought a 120 call, that would have an even lower probability of finishing in the money. And therefore, you can see that if an option has a lower probability of finishing in the money, it's worth less. Its value to the buyer is lower. And also, the danger that it presents the seller is lower, and therefore both sides are happy to trade it at a lower price. So as options become out of the money, their price goes down, and as options become in the money, their price goes up. So we can see a similar effect on the calls. If I want to buy the 85 call, then I can buy it for just 1.15 real, whereas the at the money cost me 5.778. And then, of course, if we go on the other diagonal, we can look at the in-the-money strikes. So if I was to look at the 80 call option, that has a strike which is 20 real below the market. We would say that the option is in the money by 20 real. And if I want to buy that option, it has a very high premium because it's containing a lot of what we call intrinsic value. Now, intrinsic value means that the option is in the money now, and therefore, if the market finished exactly where it is today, it would produce a positive payoff. And that intrinsic value that's being measured there is the minimum amount this option could be worth. If the stock finishes at 100 and I own an 80 call, I'm going to make 20 real per share. And you can see that this is trading at just over 20, 20.56. And that extra little bit is reflective of the fact that the in-the-moneyness, the amount of payoff that this option produces, could still go higher. The stock could move up higher than 100, and I make an even higher payoff than plus 20. Now, the options that tend to be traded are the at-the-monies and the out-of-the-monies. And the reason for this is the at-the-monies are popular because that's the strike that matches the current market, and everyone's thinking about where the stock's trading in the current market. The out-of-the-monies are interesting because their price is low. And so they represent a low probability but low price trade for me to put on. So if I think there's going to be a really extreme move up or down, then I could buy a put option or a call option, which is a long way out of the money for a very small premium that might still have the chance of producing a big payoff if we get an extreme move either way. People tend not to trade the in-the-money options so much. It's mainly because the prices are so high. And actually, and this is a little bit beyond the scope of what we want to cover today, the risks of a put option are very comparable to the risk of a call option if you actually look at the mathematics of it. And so instead of trading in the money options, people often trade the out of the money equivalent. We're just going to park that there just so you've heard that once, but for now let's just think people like out of the money options because their price is low, and they like at the money options because they're trading around the current market, and they tend not to trade in the money options too much. Okay, let's have a look at some popular trades and trading combinations. So we've previously talked about trading single options. If I have a directional view on the stock, if I think it goes up or down significantly, then I might want to buy a call or buy a put. If I think that the stock stays stationary or only moves by a small amount, I might look to sell a call or sell a put and just collect the premium. If I'm combining options together, we can create a variety of different shapes, and some of these shapes have names. The most popular traded shapes have names. And so we're going to start off by talking about spreads, and then we'll also mention risk reversals, covered calls, and straddles and strangles. Now, these first three, it's all about trading the direction of the stock still. As you'll see when we start to look at some examples, I will make money if the stock moves one direction and possibly lose money if the stock goes in another direction. These last two, though, over here, straddles and strangles, this is what makes options unique compared to trading stocks and futures, because I can trade the volatility of a stock by trading options. And so we'll see how by putting two options together and creating either a straddle or a strangle, I can be exposed to the volatility of a stock. Okay, so let's have a look at spreads first. Okay, so spreads are when I buy one option and I sell another option, and the options have the same type. So they're both calls or they're both puts. And the example that we're looking at on this screen is a call spread. So what I've done here is I buy a 100 call and I sell, in this case, a 120 call. Now on the slide, what I've tried to do here is I've tried to show you with the dotted lines the individual payoffs of both of these options. So you can see that this blue dotted line is the long 100 call, and this gray dotted line down here is the short 120 call. Now, if we just think about different scenarios here, below 100, neither option pays off. So they both finish out of the money. So below 100, they're both worthless, and I've lost whatever premium I ended up paying. If we finish above 120, both options pay off. And they're going to pay off in opposite directions because I've bought one and I've sold the other. Now, if I trade the same units of each, so let's say I buy 10 contracts of the 100 call and I sell 10 contracts of the 120 call, then the way that their payoffs are matched above 120 will be equal and opposite. So every increase in the 100 call is matched by a symmetric decrease in the payoff of the 120 call. So what this does is it has the effect of capping my overall payoff. So this overall payoff now is capped. And the level that it's capped at is equal to the difference between the two strikes. Because in this area here, between 100 and 120, only my 100 call pays off. And the maximum it can pay off is plus 20. So that's when the stock finishes at 120. My 120 call is right at the money, but essentially worthless because I need it in the money to produce a payoff. And my 100 call is 20 real in the money. And then from that point on, my maximum payoff is capped at plus 20. Now, bear in mind, that's my maximum payoff. I'm going to pay premium in order to buy these options. Now, when I looked at these numbers to plot this graph, the 100 call that I used was costing about 8 real per share. So if I buy one contract, that's going to cost me 800 real up front because one contract is 100 shares and it's 8 real per share. The 120 call was trading at a price of about 2.5. So given that I'm buying one and selling the other, the net of these two was about 5.5 real per share. So if I just clean this diagram up a little bit and just try to demonstrate the trade-off we're making here. If we buy the 100 call, we get the opportunity to get a possibly unlimited payoff. As this stock goes up and up and up, our payoff grows and grows and grows. However, it costs us the highest premium today to buy that 100 call. It costs us 8 real per share. When I trade the spread, I'm trading off a couple of things. I'm trading off a reduction of premium. I'm now paying only around about 3/4 of the premium that I originally paid if I bought the 100 call. But I've traded off the ability to make money in this triangle here. That shaded triangle doesn't exist for me anymore because my sold 120 call will cap off my profit at, or my payoff at plus 20. So I just thought, let's just have a think about what the trader's view here must be. And again, I'm going to give you 20 seconds or so to just have your own thoughts, and then I'll run through what I think their view probably is. So if this trader has bought the 100-120 call spread, what's their view? Okay, so this is my answer. I think this trader has a limited upside view, as in they think the stock goes up, but not by an extreme amount, not by a huge amount. And so what they do is when they look at the price of this 100 call, they think, just looks a bit too expensive. I'm paying here for possibilities that the stock goes way higher and produces a huge payoff. And I just think they're not realistic. I essentially disagree with the market. I think that option is too expensive. But I still think the stock goes up. So I still want to buy a call. It's just, I wish it wasn't so expensive. So the idea here is by selling another call, you can earn some of that expensive premium back. If I have the view here that the stock finishes between 100 and 120, so let's say it's starting at 100 today, I think the stock could go up, but not by more than 20%. Then if I sell somebody a 120 call and they're willing to pay me 2.5 real of premium for it, well, I think that option's worth zero, because I think the stock's not going to finish above 120 and therefore the payoff of that option will be zero. So I'll quite happily take that 2.5 real and I'll use it to subsidize the cost of my 100 call. So when traders trade spreads, it is a limited upside or limited downside view that they think the stock will move, but not significantly. And they're using this as a premium cheapening strategy. They're looking to reduce the net premium that they've paid. So this is a call spread. Equally, we can look at put spreads, and traders will match the direction of their view with the spread that they're looking to trade. Okay, here's a question for you to have a think about. You think a stock goes up, but by a limited amount. You decide to express your view using 10 contracts of the 100-110 call spread. And then there's some market data here. So the stock's currently trading at 100. The 100 call costs 5.5. The 110 call has a premium of 2.2. If I buy 10 contracts, what's the net premium that I pay? What's my maximum profit? And where is my break even? So I'm going to give you a minute or so to have a think about those 3 questions. And then we'll come back and I'll take you through the answers. So just as before, just get a number in your head, or maybe even just a methodology in your head. And we'll come back and we'll talk about what the 3 answers are. Okay, let me work through the answers to this. First thing to do is work out what my net premium is here. So I'm going to be buying one option, I'm going to be selling the other. I'm going to be buying the more expensive of the two, as in the higher priced option. My net premium is going to be 3.3 real per share. Now it's common to quote the price of an option per share, because then I can immediately put that into context and think, where's my break even? Where do I need the stock to move to in order to pay back my premium? However, when I actually pay the cash amount of the premium, it's going to be based upon the size of the option contract. So we know that one contract is equal to an underlying position of 100 shares. So if I do one contract of the 100-110 spread, it's going to cost me 3.3 times the 100 shares. So it's going to be 330 real per contract. And of course, I'm actually doing 10 contracts So the answer to question 1 is my overall premium is going to be 3,300 real. So that's 10 contracts times the net price of 3.3 per share times the contract size of 100 shares. Okay, what's my maximum profit? Let's clear ourselves a little bit of space here. My maximum profit is going to be anywhere where the stock finishes above 110. When both of these options are paying off and I've got my maximum capped payoff being realized. And so my maximum payoff is going to be equal to 10 per share. And then if I multiply that by 100 shares, that's going to be 1,000 per option contract. And then I've got 10 contracts. So the maximum payoff is going to be 10,000 real. And my P&L, of course, my maximum P&L is going to be equal to that maximum payoff of 10,000 minus the 3,300 premium that I paid for it. So 6,700 real is my max. So we've got a situation where I've got this step function, almost this diagonal step function. At the top, I make 6.7 thousand real. At the bottom, my worst case is I walk away with a loss of the premium of 3.3K, and somewhere in between the two, my P&L is 0. And to work out that point, that break-even point, we actually just go right back to first principles, ignore any of the cash calculations. We simply need to know what the net premium is per share. So the net premium per share was 3.3. So all we need is this option to finish 3.3 real in the money, and the payoff of it will pay for my net premium. So the break even here, again, I'm ignoring the time value of money. So if you've got different interest rates to the rate that your margin earns at the exchange, or the rate that your broker pays you on cash, you might see some small deviations from this number. But the break even, just as a clean approximate number, is going to be 103.3. 103.3, because that's where the 100 call will have a payoff of 3.3, and that will pay for the 3.3 real per share premium that I spent on the combination. Good. Now, if you're happy to sell that 120 call in the previous graphed example, why not sell more of it? I mean, if you take the view that the stock doesn't go up, why not sell more of that top strike call? You know, if your view is that it's worthless, but someone's willing to pay you for it, why not take advantage of that situation and sell more? So one thing that people do trade is ratio call spreads and ratio put spreads. And what we're looking at here is a 1-to-2 ratio. So if you look at these underlying lines here of the 100 call and the 120 call, you can see that the gradient of that 120 call negative payoff is twice the gradient of the 100 call, because I bought 1 contract of the 100 call and sold 2 contracts of the 120 call. And what that means is that above this high strike, now when I move right, it's no longer the case that my payoff is capped. My payoff actually starts to decline. And that's because the first unit of the 120 call caps out my 100 call, and the second unit is an outright short position in a 120 call. What that does, of course, is it further reduces the premium. If you remember, the numbers I used before was that the 100 call costs 8 and the 120 call cost 2.5. Well, now if we're doing 2 of that, then we're actually earning 5 units of premium. So our net premium to put this trade on is now just 3. So again, if we have this limited upside view where I think the stock might go up, but not above 120, then I now pay 3 instead of 8 to buy my 100 call, but I am exposing myself to negative outcomes if I'm very wrong on my limited upside view. So it's a slightly more aggressive trade. It's suitable for people with a slightly higher risk appetite. But when I was a trader, I saw lots of, for example, hedge fund traders using this strategy to express a more concentrated view on where they think the stock is going to finish. And the obvious view here is that you think the stock will finish in that green triangle. So you have a strong view around where a stock might be at some point in the future. You can capture that with this green triangle and pay a small amount of premium to take that very bespoke payoff view. Which of the following is true about buying ratio call spreads compared to regular call spreads? Is it A, the net premium is further reduced? B, you have 2 break-even points now? C, you are exposed to an unlimited loss? Or is it D, all of the above? So I'll just pause for 20 seconds, let you have a think about those options, and then we'll go through the answers. Okay, so the answer to this question is D. All are correct. So the net premium is further reduced. We saw that. You do have 2 break-even points. If we just go back to the previous graph, you now make money if we finish above 0.1 here, but you lose money if we finish above 0.2. And if we think about option C, are you exposed to an unlimited loss? Yes, you are, because this green line could keep going down and down and down forever as the stock rises. So yes, being outright short calls now does expose you to a possible unlimited loss, but it's one that you presumably think has an extremely low to 0 probability. Otherwise, this strategy would not interest you. Okay, so let's take a look at something else that people use when they're trading direction, and this is called a risk reversal. The reasons for it being called a risk reversal, they're not important to know now, but that's the naming terminology that we'll use. A risk reversal is where I express a directional view by buying one option and selling another option, except this time it's a call and a put. So risk reversals are always combinations of calls and puts. And in this case, I've bought a 110 call. So note that this is out of the money because the stock's trading at 100. And then I sell a 90 put, again, out of the money. So this is another long view. I think we're going to finish in this shaded area here. One thing to note, though, if you look at what happens if we finish in between the 2 strikes, so that both options expire out of the money and worthless, our P&L is almost 0. Because what these options will have is a very similar premium. And I'm buying one and I'm selling the other, so they're going to net to something which is close to 0. And actually, often people trade what they call a 0 premium risk reversal, where they'll absolutely choose the strikes so that the net premium is 0. So if we think about what the trading view here is, the trading view is that I want to be long the underlying stock. I think the stock goes up. I think we finish in that above that right-hand side break even. The premium is almost 0. What trade-off is being made here? Well, essentially, I'm exposing myself to this downside risk. If I just shade the area between the dotted blue line, which is just buying the 110 call, and then the full green line, which is trading the risk reversal, you can see that I'm exposing myself to possible downside. And essentially, that's how I'm paying for the possible upside. So instead of paying cash as a premium in order to have potential upside, I've paid by trading off upside possibility versus downside possibility. Stock goes up, I win. Stock goes down, I lose. And so a different type of trade to the call spread, but the same directional view and the same cheapening up of the net premium. So you will see traders trading risk reversals. Covered calls. Covered call can sometimes be thought of as more of a hedge than a directional trade, although I think they are directional trades. They're often used by fund managers. And the way that a covered call is used is if I'm long a stock, as let's say as part of my regular investment portfolio, if I'm long a stock, I sell a call option. And what that means is this is the long stock line, this gray dashed line up here. And here's my short call. So what that means is, firstly, if the stock goes down, my call option finishes out of the money, and all that happens is I've earned the premium. So as the stock goes down, I actually slightly outperform what my underlying stock portfolio would have done. I'm still making a loss, but I'm making less of a loss because the premium is giving me that extra buffer. So let's say the premium was worth 5%. Then if the market's down 10%, I'm only down 5. If the market's down 12%, I'm only down 7. If the market moves up, you can see that the action of my call is to cap off my maximum upside. So now I've earned the premium, but my call option produces a negative payoff, which matches 1-for-1 the positive move in my long stock if the stock continues to go up. The way that we tend to see covered calls being used is if the fund manager actually thinks nothing happens. The stock trades sideways, it stays relatively constant. And if it stays relatively constant, then all I'm doing is I'm earning premium and I'm adding that onto my portfolio return. So if the stock stayed constant at 100, my portfolio return would be 0, my underlying portfolio, but my option would have made me that extra 5%. So I can say to my investors, I took advantage of a calm market by selling options, earning premium, and adding it to the yield that you get. The reason why it's called covered call, by the way, covered means I already own the stock that I would have to deliver to the person who bought the call option from me. So if the person who bought the call option from me exercises, I already own the stock to deliver to them. So that's why it's called covered. Final thing before we take our next break, trading volatility. I said we could trade these combinations called straddles and strangles. We're just going to briefly look at those. There are some more complicated versions of these called butterflies and condors. And again, I'll quickly show you the payoffs for these before we take a break. Okay, so this is a straddle, nice and simple. We buy a call and a put with the same strike, and it produces that nice V shape. So now we've got an option combination that will pay off in either direction. If the stock goes up, I exercise my call. If the stock goes down, I exercise my put. But of course, I'm buying 2 options now instead of 1. So it's going to cost me something that looks like 2 times the premium. So this is a volatility trade because I want the stock to just move. I'm not saying I want the stock to go up or down, just one way or the other. Just move, essentially, is my request to the stock. So this is one way where a trader would trade the volatility of a market. What we're hoping is if we're long this straddle, we get a big move in either direction and we finish in those shaded areas there. Of course, if I think the stock remains stable, I can sell a straddle and earn this double premium in that triangle at the top where we finish between the 2 break-evens. So going long straddles and short straddles is a way of expressing a view on the volatility we expect between now and expiry. A strangle is the same as a straddle, but we've just stretched those strikes apart. So the most common way of building a straddle is using at the money strikes. So if the stock's trading at 100, I'd buy the 100 call and the 100 put. With a strangle, I just stretch those strikes apart, so now both options are out of the money. So I might do a 110 call and a 90 put. That reduces the net premium that I pay, so my maximum downside is now lower, but it also increases the move I need in the stock in order to produce a positive P&L, as in it moves the break-evens further out. It's still a long volatility trade. It's a slightly watered down version of a straddle. And here you can see a trade that we call a butterfly, which is actually when people trade straddles versus strangles. And on the left-hand side, we've got an equal weighted butterfly where we've sold a straddle and then we've bought a strangle. And on the right-hand side, we've got the more usual picture we see when we think about butterflies, where somebody has done a ratio butterfly, as in they bought more of the strangle than they sell of the straddle. And their view, of course, here is we finish either in this middle triangle or we get a big move one way or another into these shaded areas. Final slide before we take a break. Condors. Condor is when I do one strangle versus another with different strike spreads. So you can see that now I can capture this view that the stock finishes between there. That was the slide before last. This is the last slide before we take a break. Everything we've talked about so far is what we call vertical spreads, where everything has the same time to expiry. So I might be buying a low strike call and selling a high strike call. We can also do what we call horizontal spreads, or what are probably more popularly called calendar spreads. And this is where I buy or sell a short expiry option, and then I sell or buy a long expiry option. And you can see that we've got a view here that we want to sell a short expiry option and buy a long expiry option. And as we'll see after the break, there's a price difference between these two. And people who are trading calendar spreads or horizontal spreads are either expressing a more complex view on the journey the stock will take between the two different expiries, or they're expressing a view of on the relative prices between the short expiry option and the long expiry option. So calendar spreads can be used to trade the different prices on this expiry term structure. But we'll leave it there. We'll take another 5-minute break. We're going to come back and we're going to talk about option pricing, volatility and risk for the remaining approximately half an hour of this webinar. So again, time to step away for 5 minutes. I will see you in 5 minutes time, which will be about 11:33 Riyadh time. So I'll speak to you then. Okay, welcome back. Final session. Last 30 minutes or so before we have time for questions. Just a reminder, if you do want to pop those questions in the reply to the post on X, then please do so. We've got a few questions that we're going to already address at around about 12 o'clock. But if you've got any more, please send those through now. Good, right, so the final section is going to be on option pricing, volatility and risk. Possibly the most complicated subject that we've covered so far in this webinar. We're going to try and take it nice and steady and do things intuitively. Okay, so let's move to the slides. Firstly, let's recognize that there are a few moving parts to the price of an option. There are 4 things really that can change its price. And we're going to look at the effect that each of these 4 has. Now, I've included the strike here because if I'm thinking about which option to trade, then if I choose options with different strikes, that is going to change the premium of the option. But of course, once I've chosen an option, its strike is fixed. And so once the strike is fixed, there really just becomes 3 things that can change: the stock price, the volatility of the stock, and the time to expiry. So we'll talk mainly about how those 3 things have an effect. Firstly, I thought we'd liven things up with another question for you. So I just want you to have a think. Why do you think that the volatility of a stock, so by volatility we mean how much does the market move around on a day-by-day or week-by-week basis? Why does the volatility of a stock change the price of an option? And you might want to start by asking the question, why does the volatility of a stock not affect the price of the stock itself? But options are affected by volatility. So just have a think about this. I'll give you 30 seconds to just have some thoughts. Then I'll go through my way of explaining this. Okay, so let's have a think. There's 2 different ways we can attack this question. Firstly, we could say, what if we've got a stock that's trading at 100 and we've got a strike on a call option up at 125, let's say. And then I told you that the time to expiry was 1 year, but that this stock, the volatility of this stock was low in that generally over the average year, it only moves by plus or minus 5%. If I told you that the stock could only really move up or down by 5%, you're going to think, well, it's going to finish somewhere in a 105 to 95 range. I'm never going to get to that 125 strike on the call option. So you're going to think that that call option has a very low value to you. And obviously, you're not going to want to pay very much for it. But if I said, oh, actually, and let's just exaggerate the numbers here, actually, this stock has a very high volatility, and it can move up or down 50% in a regular year, you're thinking, well, now we're talking. Now we can have a big move up. All right, we might also have a big move down, but the beauty of call options is a move down. It's all worth 0 to me. It doesn't matter where we finish between 99.9 recurring or 0. All of that is just, I'm going to walk away. All I care about is upside moves. And so what this higher volatility has done is it's increased the probability that this call option will pay off compared to when the volatility was lower. The other way of explaining the effect of volatility is to think about what might happen to an at-the-money option. If we have an at-the-money option, so the stock is 100 and the strike is 100, and we think of 2 different scenarios, one with low volatility, one with high volatility. And let's say that there's just a symmetric move in the stock. So we've got our low volatility scenario where the stock can move up or down by 10. And if it moves up by 10, our option will have a plus 10 payoff because we can buy at 100 and sell at 110. And if we move down by 10, then our payoff is 0. And let's say the probability of each move is 50%, which is generally what we assume in markets. We assume they're trading in equilibrium between supply and demand. A move up or down is roughly 50-50. So my expected outcome, so let's call this E of O, my expected outcome is going to be +5, because half the time I'm going to make 10 and the other half the time I'm going to make 0. So on average, I'm going to get a payoff of +5. Now let's move to a higher volatility scenario where the stock could move up to 130 or down to 70 from today's starting position of 100. And again, let's keep the probabilities the same. Oops. So the probability is the same. Apologies, just bear with me a second. I managed to crash my screen share. Okay, we're back. If we just switch to the slides. Okay, upside, downside, just to refresh where we are, we've got this high volatility movement now. The stock can go up to 130 or down to 70, again with a 50-50 probability. Now, my maximum payoff if we go up is +30, and my payoff again if we go down is 0. And you can see the effect this is already having now. My positive payoff has increased, but my downside payoff is still 0. And it's always going to be 0 when the stock finishes below 100. So now my expected outcome is going to be +15. On average, I'm going to make 15 real, whereas in the low volatility situation, on average, I only make 5. So if I think volatility will be high, I will pay more for an at-the-money option than I would if I thought volatility will be low. And so essentially that's the crux of everything to do with volatility. Here's a summary slide of how movements in all of these things affect the price of an option. And you can see if we just have a look at the call price column here, you can see as the stock moves up, then the call price moves up. And we'd expect that the call is moving in the money or maybe less out of the money. And so it's becoming more valuable. If you look at the price of a put, as the stock moves up, the price of the put will go down because the put is either becoming less in the money or more out of the money. If I change the strike, and bear in mind I can only change the strike before I make my trade, if I move the strike up on a call option, its price will go down because I'm moving the strike ever higher and the stock has to move up even further to get into a positive payoff scenario. But if I move the strike of a put up, it becomes more valuable because, of course, that's where I get to sell. So the higher the strike, the higher the price at which I can sell through my put option compared to a certain market level. So with these directional variables, you can see opposite movements from calls and puts. So one moves the price of a call up and it moves the price of a put down and vice versa. But when we get to volatility, increasing the volatility raises the price of all options, both calls and puts, because it means that that enhanced positive payoff is there, whether it's either on the upside for a call option or on the downside for a put option. And finally, time to expiry. Time to expiry also has a symmetric effect, affecting calls and puts equally. And it has the same kind of effect as volatility has. So here we've modeled a move down in time. So today becomes tomorrow. I have one less day in my options expiry, and you can see that the price of both calls and puts declines. This is something we call time decay. And it's represented using the Greek letter theta. So you might have heard of time decay in options. We'll come back and deal with these Greek letters a little bit later on. this is a way we might think of the option price being made up. I've spoken already about intrinsic value. This is just telling us how in the money is the option. And the time value is telling us everything else that could happen. Not just that bare minimum amount of intrinsic value, but the what if question. What if the stock moves even further up? Or with a put option, what if the stock moves even further down? So when I have an option which is out of the money, so this is a 100 call, so anything to the left of 100 on that x-axis, the option is out of the money, it only has time value. It has no intrinsic value right now, because if we expire here, it's worthless. It only has time value. As it becomes in the money, it starts to generate a mixture of intrinsic and time value. One thing you can see from this graph down below is that if this top curve, so you see the really curved light green section, if we move either far to the left or far to the right, then the option is either worth 0 or it's just worth its intrinsic value. And that is because as the stock moves to extreme levels relative to the strike, the option basically dies. It either becomes something that will never be exercised. So if we move down to 0, my probability of exercise is now tending to 0. And if I have a 0% chance of exercising a call option, it doesn't exist. It's nothing. It's just a piece of paper. And therefore it has no price, and therefore it also has no risk. As we tend up to the right-hand side here, the probability of exercise up here is tending towards 100%. Now, if exercise probability tends to 100%, if it's at 100%, what it means is I am definitely exercising my option. So it's not really an option anymore. It's just a delayed decision. My decision is I'm going to buy. Now it's just a case of when. If it's an American style, I can do it now. If it's a European style, I have to wait until expiry. So something which is deep in the money and has an exercise probability of 100% is actually just a position in the underlying stock, which is why the option will just be trading at its intrinsic values with no option-related risk whatsoever. It's only really in the middle, around the strike, that things get properly interesting with options. And that's another reason why people trade the at-the-money options, because the price is most mathematically interesting there. Okay, this is probably the scariest slide of the whole webinar. This is the famous Black-Scholes formula. You can see the title up at the top of the slide. Black and Scholes were two mathematicians who were responsible for putting together some of the early work on option pricing theory, and they developed this pricing approach. We don't need to know what all of the letters on the screen necessarily mean, but I will just point out that we only really see 4 things here. We see F, which is the futures price. So the price of an option is related to where the futures contract trades. We see K, which is the strike. We see F and K again down here. We see this sigma, which is the volatility. And we see T appearing everywhere, which is the time to expiry. So those 4 variables that we told you about a few slides ago, the Black-Scholes formula only has those 4 variables. And so it might look a little bit fearsome on paper, but in practice, this is quite easy to code up. And in actual fact, if you're very careful, you can get this into one cell of Excel. And that makes it nice and simple. It makes it very quick to calculate, very easy for a trader to use to price. And so most of the prices that you'll see on the stock exchange or on any kind of electronic platform will be a Black-Scholes derived price. We put a volatility into this, time to expiry, a futures price, and a strike, and it will give us the call price or the put price. One thing I want to mention, and this is a slightly advanced topic, so I don't want to dwell too long on this, but when you trade options, you will see that they don't all use the same volatility in their price. And we talk about the volatility smile and the volatility skew. So I just wanted to introduce these terms just so you've heard them. A smile is when volatility follows this smiley shape here. So the at-the-money options will have the lowest volatility, and then it will increase as we go into what we call the wings. So once we move into out-of-the-money calls and out-of-money puts, they'll have a higher volatility. Skew is not the smiliness where the out-of-the-money options both have higher volatility. Skew is when we have a systematic bias between, sorry, I've just flicked my slides. We're back on the right slide now. Skew is when we have a systematic bias between the price, the volatility applied to a put and a call. And so you can see in this situation, we've got something that we call negative skew. And so the put vol will be high and the call vol will be low. And in practice, what we tend to see is a combination of these two effects. So we can end up with a combined skew and smile that might look like this, where the at-the-money strikes are somewhere around here, and quite a complex shape driving those volatilities. As I say, beyond the remit of a nice introductory webinar like this, but I thought I'd just mention it in case you see this. This is being driven, by the way, by the fact that the Black-Scholes price itself is not completely correct. And so traders will correct for the problems in Black-Scholes by quoting a different volatility for every strike. Good. Okay, final section of the course is a piece on risk, and we're going to introduce these Greeks. You might have heard of the Greeks when it comes to understanding option risk. What the Greeks do is they allow us to be able to quantify our risk and to be able to predict what our P&L will be if we get a certain market move. So we'll just introduce the Greeks. We'll have a little look at a numerical example I believe we've got coming up in the slides. So once we've traded an option, the strike is fixed. There are only really three things that can move. That's the stock price, the volatility, and the time to expiry. And so each one of those has a Greek letter. And so the exposure to the stock price we call delta, the exposure to volatility we call vega, and the exposure to time we call theta, or just time decay. And by the way, vega is not a Greek letter, but it's just the word that's used by traders to describe their exposure to volatility. And it's lumped in to this family of terms that we call the Greeks. Okay, so if you were to look at a trading platform which showed you risks, this is the kind of display that you might see. So again, down the center, we've got strikes. So if I'm looking at calls and puts down the middle, therefore different strikes. My call information is on the left, my put information is on the right. So if we just focus in on a particular call option. So let's say we choose the 105 call. The 105 call is trading at a price of 206, and that'll just be the middle of the bid and ask price on the exchange. And you can see that I'm given these risks here. 0.33 is my delta, 0.18 is my vega, and negative 0.02 is my theta. Now we're going to go on now and tell you what these numbers are actually telling us. Oh, and actually on this slide, I focus in on the at-the-money option, which is the 100 strike. So if I just go back one slide, the next slide is going to be looking at these numbers here for the 100 strike. Okay, so each Greek here is telling us how the option price changes for a 1 unit move in the relevant price driver. So that will be the underlying stock for delta, volatility for vega, and time measured in days for theta. So what my delta is telling me here, this 0.52 number, it's saying that for a +1 move in the stock, the option price moves by plus 0.52. So to give you an example, if the stock went up to 101, then my option price will equal the original price of 3.99 plus 0.52, which gives a new price of 4.51. And if the stock was to go up by 2, I would just multiply this bit by 2 and calculate another resultant position in the final price. So you can see that that's giving me the way that my price changes. And because price changes are driving my profit and loss, delta will tell me what my profit and loss is as the stock moves up and down. Vega is telling me that for every 1% move in volatility, and volatility tends to be quoted in percent. So if I've got an original volatility of 20% and then it moves to 21, then my option price will increase by 0.2 real per share. Theta is telling me, usually theta is measured per day. So theta is telling me what 1 day's worth of time value means. And in this case, it's 0.02 real per day. So if I want to convert these risk metrics, so these are things like, for example, delta, vega, and theta. If I want to convert those into my position risk, so what's my position risk in real on a certain option trade, then I multiply the metric by the contract size, and then I multiply by the position in contracts which I own or I'm short on that particular option. So for example, let's say I trade an option, I buy that 100 call and its delta is 0.52. And my position is that I buy 10 contracts. 10 contracts is the same as 1,000 shares. And bear in mind, if I bought 1,000 shares and the price went up or down by 1 real, I would make 1,000 real per 1 unit move. Buy 1,000 shares at 100. If they're now trading at 101, I've made 1 real per share on 1,000 shares, which is plus 1,000 real profit. So with options, my position delta is equal to my options delta of 0.52 multiplied by the contract size of 100 shares multiplied by the number of contracts which I own. So that's 5,200 real. So what that's saying is if I buy a 100 call that gives me an equivalent position of 1,000 shares, my P&L will change by 5,200 real for every 1 real movement up or down in the stock price. So that's a way that you can take a position and you can understand numerically what kind of P&L swings you're exposed to. And each of these 3 metrics can be quantified independently, and then we can add them all together. So my P&L on any particular move is going to be the stock move that we've realized multiplied by my position delta, plus the volatility move multiplied by my position vega, and the time change multiplied by my position theta. And I just point out at the bottom, options are dynamic instruments. Their risks will change as all of the variables move. So this calculation of P&L is only ever an approximation, but it's a good enough approximation over small moves for you to understand how your P&L changes. Good. Well, that actually brings us to the end of the session. So thank you for attending. We've seen some great numbers following on X and the various other platforms that you're on. So thank you very much for your time. I hope you found some of that useful. I'm now here for up to 30 minutes to answer your questions. So I know we've got a couple of initial questions that I'm going to be addressing straight away, but now's your chance, if you want to quickly reply to that post on X with any questions, and the Financial Academy team will pick it up. So while I have a quick look through the questions, again, just thank you for joining us. Hope you found it useful. Hope you now know a little bit more about trading options than you did 2 hours ago. Okay, so I'm just looking at some of the questions that have come in. So the first question that I've got here is somebody who's asked, can I use options when there is a lot of volatility in the underlying stock? And the answer to that is yes. What you'll find, as we've seen, is that when volatility is high, options are expensive. And so if you're looking to place a directional trade that thinks that or expresses the view the stock will go up or down, you're going to pay a lot of premium for that trade. Now, that's justified premium, because if we've got high levels of volatility, we are expecting a big move one way or another. So you'll have break-evens that are a long way from the current market, but they're justified. When traders approach a situation of high volatility, what they'll often do is they'll be more inclined to trade a spread instead of an outright option. So they'll buy a low strike call, sell a high strike call, buy a high strike put, sell a low strike put, reduce the premium, allow that high premium of the option they're selling to net them down to a lower premium for the package. And that's the way that they would stay in control of their premium. But absolutely, options work in every scenario of volatility, but they will always be pricing in the market's expectation of volatility. So expect to pay higher prices for options when the market thinks it will be more volatile. Another question said, should I only use options when the stock direction is clear? Tricky to answer that, because in principle, the stock direction is never clear. I mean, stocks trade on the equilibrium between buyers and sellers. My default assumption in the absence of any other knowledge is as many people think the stock goes up as goes down at any point in time, and therefore the future direction of the stock is really 50-50. If it's clear to you, though, so essentially you're disagreeing with this market equilibrium and you're thinking, no, the price of Aramco or STC or something is definitely going higher or definitely going lower, then I would say options are a very good way of expressing that directional view. You'll pay a relatively low premium in terms of the fraction of your position size, and then you're exposed to big payoffs as a multiple of your premium if your directional call on the market is correct. But it's always worth just second guessing yourself. If you think there's a stock which you think is definitely going to go up, just question why it's trading at the market price that it's trading at right now, because there must be sellers who think that it goes down. Would it be better to buy a European style option or a futures contract for a stock if I believe the option price will rise significantly? What's the difference in the expected profit between the two? Okay, so the stronger your view is that the stock goes up, the more you might want to just trade a futures contract. If I just trade a futures contract, all I need today is the initial margin. In theory, a futures contract has a zero value on day one, but because I trade it on an exchange, I have to put down a small margin in order to trade. The futures payoff is perfectly linear. So if the market goes up, I win. If the market goes down, I lose. But if I strongly think the market goes up, let's say, then I'm only focusing on that winning side, and I've not had to pay an upfront premium for this position. So if I buy a futures contract that's trading at 100 and we finish at 150, I make plus 50. If I trade this using an option instead, then the payment of premium is going to reduce my overall P&L. So let's say I buy a 100 call and the stock finishes at 150. The call pays off plus 50, but I'll have paid some premium for it. Let's say I paid 5 units of premium. I'm only up 45. So the future would finish at plus 50. The option finishes at plus 45. What the option gives you, though, is a safety factor. And so the more conservative or maybe risk-averse trader might prefer to express a significant move-up view with a long call option because they're just thinking, what if I've got this wrong? What if the market moves down instead? Because if the market moves down with the long future, I'm exposed to a potentially huge loss. Whereas if the market moves down with a call option, I just lose my premium. And that's a reassuring position to be in. Maybe that's the reason we can sleep at night when we've got a big trading position on, because we know there's a certain maximum loss that we're exposed to. So really, it's just trade-offs. Some people will express this in a mixture of the two. Some long futures positions, some long call position. I'll blend the two together. They both have pros and cons, and my combined position will reflect the combination of those two. Okay, next question is, which is more profitable in general, vertical or horizontal spreads? So if you remember, a vertical spread is when I'm trading the same expiry, but different strikes. And a horizontal spread is usually when I'm trading different expiries, usually with the same strike. Now, it's difficult to answer this question, which is more profitable, because the profit that results from these strategies will be a function of what happens to the stock, and also with the horizontal spread, what happens to volatility and time decay as we move through time. Both options will be profitable in different scenarios, and both strategies will lose you money in different scenarios. So if I'm trading vertical spreads, that's more of a directional trade on the stock. So for example, that 100, 120 call spread we looked at, I think the stock goes up. I think the move up is limited. I'm happy to sell that 120 call. I really think we probably finish somewhere between the two strikes. If I'm trading horizontal spreads, so calendar spreads, and let's say I trade 100 calls and I sell a 3-month call and I buy a 6-month call, then possibly what I'm thinking is the market goes up, but later. So the market trades sideways for the first 3 months and then it increases. Now, what's going to happen there is, because I've sold one option and bought another, I'm just going to pay the net premium. The longer dated option is going to be worth more, so I'm going to have paid a small net premium out. But that short option is subsidizing my premium in the same way that it did when I traded the vertical spread. So if I think that the stock will maybe dip down and then go up, then selling the short dated call option, buying the long dated call option would be a good trade to do. However, most people in my experience who are trading horizontal spreads are not trading it from a stock direction point of view. They're trading it from a volatility point of view. So they might look at short dated options trading with very high volatilities, and longer dated options maybe trading with slightly lower volatilities, and they might think, I think that's wrong. I think they both should have the same volatility, or maybe they should be the other way around. And so if they think that the 3-month option looks expensive and the 6-month option looks cheap, they'll look to sell the first option, buy the second option. And then what they're hoping is, as time passes, the market either corrects to a more equal situation, or just as time passes and we roll down towards today, they'll just capture the difference between the extra value that they sold the 3-month for compared to the value that they bought the 6-month for. So trading horizontal spreads, it's more complex than vertical spreads. There's more moving parts. People have different motivations for trading these, so it's not easy to put a which is more profitable distinctive answer on that. I've had a question which was, what was the most successful option trade you did? Okay, so when I was a banker, I was a market maker. So the job of a market maker is to make prices into the market. So I was primarily I was an interest rate option market maker, and I think probably there aren't many strongly positive experiences that stand out as a market maker, because what you're looking to do as a market maker is you're looking to trade regularly, always manage your risk, and lock in small amounts of profit. One trade in particular does stand out, and it was with a hedge fund. It was with an American hedge fund. And I had the opportunity to quote this price. And it's slightly long-winded, the story, to go into it. But I remember that a slight piece of information allowed me to adjust the price at the last minute. And we ended up as a bank making much more money from that hedge fund trade than we otherwise would have. And so it's just, if just being plugged into market information flows and just hearing shouts down my speakers allowed me to quickly at the last minute change my price and make quite a bit more money from that trade with a hedge fund than I would have otherwise. I think the more interesting question here is not what's the most successful trade you've ever done, but what's the worst trade? Every trader remembers the pain of their worst trades. And I think probably my most chastening experience recently was when we went into COVID. Now, I'm naturally always going to look at the prices of options, and the way that I look at them is I look at them mathematically, and I try to think, are these options too high or too low? When we went into COVID, the way that options on US stocks were trading and UK stocks was that put options were very expensive compared to call options, this skew feature that we talked about before. And I quite like trading the smile and skew of options. It's what I used to do as a professional options trader when I was a banker. And so I was looking at the cost of put options on the London Stock Exchange and also on the New York Stock Exchange, and just thinking, how is that justified by the underlying macroeconomics and the underlying fundamentals of the market? I saw there was a big bid for puts, so a lot of people were buying puts, and the price had gone way up. So I actually took a short position on my personal trading account, a short position in puts on the S&P 500 and also the FTSE 100 in London. And this was in mid-February 2020. So we already knew COVID existed in China, but it hadn't really had any major worldwide economic effects. Of course, over the next month, stock prices collapsed by 30%. I'm panicking my way out of my short put positions, but not before I'd suffered what in personal terms was a quite painful loss. It didn't take me down below zero on the year, but it knocked a significant amount of my annual P&L out of the window, and it all happened over a few days. So I think that's, even though I've been involved in options for over 25 years now, you're never too old to stop making mistakes, and you should always learn from those mistakes. And next time, just think, what could I not know here? What could I not have foreseen in terms of what might happen next? Good. Okay. Well, thank you for those questions. We don't have any more questions at the moment, so I'm happy to just wrap things up now. Just once again, on behalf of Zishi, thank you to the Financial Academy for hosting us today. Thank you to everyone who's viewed us on the live streams. I hope you've got something interesting out of this, and it's been my pleasure to be your host today. Thank you very much, and goodbye.